This is the BioCentury Show. The BioCentury Show is brought to you by the second BioCentury Bay Helix East-West Biopharma Summit. Join us October 2nd to 4th in Kendall Square to debate how to globalize biopharma innovation to benefit patients and achieve an ROI for investors.
Hello and welcome to the BioCentury Show. I am Simone Fishburn, Editor-in-Chief at BioCentury, and I am joined today by Arthur Franken, General Partner at Gilde Healthcare. Arthur, you're situated there in the beautiful Netherlands, just a stone's throw from Dublin, where we were. It's May the 23rd. We are both coming out of BioCentury's BioEquity Europe conference that was last week in Dublin. And, you know, it was a very full conference. There was a lot of energy, I thought. A lot of investors, a lot of people looking for money. It looked like there were deals on the sidelines. We'll maybe hear about that. But I want to start by asking you, coming out of that conference, what your top line impression is about the sentiment in biotech right now, or at least biotech in Europe.
Yeah, thank you, Simone. It was really, thank you for having me here. It was really a very energetic, vibrant conference. I think you hit many records there in terms of attendees. And for us, it's always the go-to conference, without a doubt, kind of the must-attend conference. Clearly, I think everyone had that question going into this conference: what will be the talk of the town? And of course, everyone is talking about the capital market environment out there. And but actually, coming out of that conference, I think that there were definitely positive signals there. Positive signals that were kind of developed and shared across the various strong panels you had at that conference. It was about kind of like, we've been here before, although not quite the same as previous. We will get through it. Yes, it's a time of capital rationing right now. What does it mean for companies? What does it mean for CEOs? What does it mean for investors? But kind of more like a constructive view of the situation rather than an absolute, pessimistic mood. I think really reflected by the attendees there, and also by the news flow in and around the conference. A news flow consisting of new funds being raised, large funds being raised, some M&A activity we see through the news media. So definitely not all negative, Simone.
All right, well, you went straight there. So let's talk about some of those funds, right? Gilde, I think it was about the week before BioEquity or a few days before, you recently announced the close of your Gilde Healthcare Venture and Growth 6 fund at 600 million euros. That's about $659 million. And that was the same week as two Forbion new funds. Together, those three funds were three of the four largest ever funds in the EU life sciences VCs among those. So there is a fair amount of dry powder. Now, you're right, that's at the same time as a lot of conversation on capital rationing. And, I want to ask you how companies should view this in light of what we're seeing, even with private funding, where I would say one of the top things coming out of the conference is that, flat rounds are the new up rounds. So how do we reconcile this ton of money with capital rationing? What are you thinking?
Yeah, absolutely. I think net the message should be positive, right? Absolutely positive. Gilde raising 600 million euro in record fund for us. This means for all those CEOs out there, come and see as Gilde is active, where we have grown as a result of, I would say, not only track record, not only the fund numbers, not only the performance numbers, but also a track record that derives from a clear strategy, a strategy that we've deployed over the last 2 decades. And that strategy has been shared over the years with all the CEOs we get here in our office, the CEOs we meet while being on the road. So that strategy, I can come to that later, Simone. But clearly what I think net, it's super positive news. It's not only Gilde, it's clearly other funds out there that have done extremely well. For us, this is a growth from previous fund. Previous fund was 416 million euro, where now it's 600 million euro. And even more so, we managed to raise that in a fairly short period of time, 2 quarters. Now, there is a certain recipe for success there. I can go into that, but can go into that later as well. You know, as I mentioned before, it's not only track record, it's also a result of a combination of strategy resulting in that track record, as well as be in the market, you know, continuously, establish contacts with LPs, be good in timing, and convey the story very well to LPs that like the sector, that like healthcare, that like innovation in healthcare, that like biotech, but find it too complex and go to kind of domain experts like Gilde. So good news for the entrepreneurs there, looking particularly for, I would say, later stage growth financing. That is what we're looking to do with this new fund. You know, we can go into the specifics more, but it's clearly good news, Simone.
Well, I do want to come back to the specifics a little bit later and spend a couple more minutes on, you know, the environment and the ecosystem. You know, one sentiment that just came up in conversation after conversation, panel after panel, is, you know, European biotechs have always raised less than their US counterparts, and I think than their China counterparts more recently, and they've had less to live on, and that actually they are sort of better trained and better prepared for this capital rationing environment. Do you think there's anything in that?
Yeah, absolutely. It was definitely also addressed in a panel I was chairing. You know, biotech in an era of capital rationing, and that was well attended. Some very good panelists, some very good discussions. And actually, what came out of that, slightly as a positive, is Europeans' track record in, I would say, developing and progressing in an environment of limited capital sources. Now, this has often been the criticism for slightly slower growth in Europe versus the US, but now it was put in a slightly more positive framework. Now it does, you know, it is a harsh reality, and we're now in this situation where capital markets are definitely not positive, bearish if you want, and not every cycle is the same. So we've been through this in, you know, the last 2 decades that Gilde Healthcare has been pursuing its venture and growth capital strategy, 2000, 2008, and a couple of other intermediate weak years. We've been there.
Let me ask you what, and you know, you talked about LPs being enthusiastic. You know, what are the differences? Are the fundamentals different? I mean, the fundamentals are very good in our sector. I think we could probably agree on that. Is that something that LPs are more aware of? Is it the success of mRNA, or are they seeing new novel therapies come? How do you think that this is different this time?
I think different this time. I mean, when I think about what made us success in the fundraising, what made us successful in this fundraising specifically, and that applies to some other top tier funds as well that managed to raise larger funds despite, you know, the negative situation in the capital markets, is that you can show that you have been there before, that you have managed your portfolio through these cycles. Also show that you have a strategy, an investment strategy that delivers on its promise, that you can execute, show that you have a multi-fund, a successful track record across multiple funds. I think all of that matters, absolutely. And then Over the last 2 decades, I would say, Simone, that the European biotech ecosystem and the entire healthcare innovation ecosystem also has evolved, has matured. And that message and those signals come through to LPs as well. Definitely funds have done very well for LPs. That maturing of that ecosystem, Simone, is across multiple facets. So that means that pharma has really embraced this form of open innovation, external innovation, really kind of formalized it and institutionalized it. When I started this work 2 decades ago, clearly pharma was very difficult to connect with. Now it's completely different. They're completely integrated into the ecosystem. M&As are up, collaborations are up. More product successes. That's what we're all doing it for. Biotech companies that are contributing basically 70 to, I've heard the number, 70% of all approved products kind of find their origin somewhere deep in the biotech ecosystem. So all of that stacks up to a maturing European ecosystem and a recognition by LPs that this is a super exciting, growing, and attractive sector that does require specialized investors.
Right. So, I think that that's really important, because one of the other things that we do see is, new people trying to create new VC funds. And obviously they don't have a track record because they're new. So I think those are a little bit difficult to get off the ground, but we are seeing them come through. And I want to talk a little bit about, you've brought me to the pharma question. It's mostly pharma, but, money is obviously hard to come by, and that puts a lot of pressure on deal making, making it a buyer's market, of course. But we're also hearing, I was also hearing at the conference that some deals behind the scenes are actually very competitive. What can you tell us about that?
Yeah, I think biotech has always been an industry of very heavy R&D, and when R&D is involved, it means attrition, and it's a mega industry, as we all know. Huge hundreds of billions are being spent in R&D, and that means whenever positive data emerges, immediately the premium of scarcity value comes in. And I think scarcity value is something that even in down cycles will always be there. That applies to large pharma pursuing aggressively external innovation. We all know that they have tens of billions of dollars earmarked just for external growth or inorganic growth in their M&A war chest. And whenever there are good data, there is extreme competition, I think, for assets. Now, in addition to that, Simone, what I at least see from where I am is that it's not only a sector anymore that consists of big pharma that's consolidating. I think really with the maturation of the biotech ecosystem, you also see these kind of mid-sized biotech companies that are a couple of billion in terms of market cap and pretty much are searching for new assets to acquire. Those companies have a very specific, laser-sharp focus effort towards external innovation and inorganic growth, and that's a good thing. So the M&A landscape in the sector, both in Europe and the US, is expanding. It does not only exist of big pharma anymore. So huge competition, I would say, might not be always that visible. Doesn't only apply to M&A. I think there's still competition amongst investors for late-stage assets. So the premium applied to scarce assets is still, from the point of where I'm sitting, very visible.
So we'll go to a break in a minute, but I want to ask you this one question, talking of very deep pockets, okay? This time last year, the conversation was really largely around the entrance of private equity into biotech. Apollo had signed a deal for a minority stake with Sofinnova Partners, And that was sort of after, I think, the first in 2018, an acquisition of Claris Ventures by Blackstone. Later, we had the buyout of LSP by EQT and Abingworth by Carlyle. Now, had a few years to see how these are playing out. Do you expect to see more of these PE buyouts of VC funds? And are they having an impact on the investment landscape?
I find it very hard to say there will be more. I think that clearly, there are some firms you didn't mention, but that have kind of built in-house venture capital activities like KKR, TPG, Bain. They have developed their VC arms in-house. So I think you can make a nice list of these multi-billion, asset managers. And then you're really talking about, I think, assets under management of hundreds of billions. These are really big gorillas out there. Whether you will see more transactions like that, I think the list you just named are VC firms that have grown over the last decades, are very large, have multiple fund strategies. And yeah, there are definitely pros and questions around those partnerships. So I can see it from my point of view, the intellectual, let's say, thinking behind it. But for me, Simone, time will tell whether these partnerships will bring in the long term what both parties expected from it. From a PE perspective, I clearly understand that the common denominator amongst all the transactions you mentioned is that these big fund managers want to have access to arguably one of the world's largest industries, healthcare innovation, if you want. And at the same time, they know this is a super complex and highly regulated sector that really calls for deep sector expertise. And you probably also see the degree of impact investing that becomes relevant for the complete financial industry. Now, clearly, healthcare and impact investing can go along very well. So I think it also ticks that box. That's also a driver. It makes a lot of sense, again, from an intellectual and strategic perspective. And I don't want to be negative at all about it. I think smart deal structuring here can really create win-win situations. From the target perspective, if I think about these deals from an independent general partner perspective, you can think about, that gives me a very strong cornerstone investor in times where fundraising is more challenging, arguably, despite the fact we managed it in 2 quarters, our 600 million record fund. I don't want to suggest that it was easy. It was not easy. It also provides you with access to a broader LP base in the future. These mega fund managers have investor relation departments of 50 to sometimes 100 FTEs. It's amazing. Complete independent companies, investor relation departments, whereas funds like us do it as a team effort. But really, the people leading the charge on this is probably 3 people. So another argument from a GP perspective, why to engage in these things is, it is part of your future growth strategy. If you want to grow across multiple fund strategies, diversify fund strategies, and each of these strategies you want to grow, it is a legitimate proposition. And it helps also to leverage the financial expertise that exists within these fund managers. So think about developing other financial instruments than only equity. Apollo, for example, is known for its track record in credit facilities and things like that. Real estate, perhaps, healthcare starts to play an important role in some local real estate things. You can go on and on and on. And I've not been part of those discussions. And whether, there will be more, hard to say. What it will mean in the long term, Simone, I think there's a lot of, let's say, intellectual thinking behind it. I can also imagine that if you become part of a very large group, it might be more challenging. And again, it depends on the deal structure. It might be more challenging to maintain your independence. At Gilde, we find that extremely important to maintain our degrees of freedom. And by the way, within Gilde, we've grown, and we have grown actually our own private equity healthcare focused group of funds within Gilde Healthcare. It's managed by separate teams, so it's a bit of another twist to the same topic.
Well, thank you. That's a very full answer. We will go for a break now, and we'll be back in a moment. Thank you.
Emerging biopharma companies in the US, Europe, and Asia face the same dilemma. How do you globalize to deliver innovation to patients and reward investors? A handful of biopharma companies will build global operations. Most will achieve global economics through partnering and licensing. Others will capture a share of the economics by enabling global development and financings. This October in Kendall Square, BioCentury and BayHelix once again bring together decision makers and investors to address these industry challenges and to form trusted cross-border relationships. Register today at biocenturyeastwest.com.
Okay, we are back at the BioCentury show with Arthur Franken from Gilde Healthcare. Arthur, I want to switch now and go to some of the strategic issues that you pointed to, and I want to raise some of the things that came up at the conference and ask you how you deal with that and think about that for your portfolio companies as well as across across the ecosystem. Now, one of the themes was around for European companies when and where to go public. It is clear that NASDAQ has just become the behemoth. It's really the destination of choice in biotech globally. At the same time, about half of European companies go public on their local exchanges, and they often struggle to go public on NASDAQ, and when they are public, to succeed on NASDAQ. So maybe you can talk a little bit about the dynamics, and this is not a new hurdle for European companies. Is it ever going to be overcome? Do we move to a sort of a more sophisticated base of companies in Europe that are better able to navigate NASDAQ, or what will it take?
Yeah, it's a very good question, Simone. I don't think that there is a single answer, but there are many good and bad examples. So the way we approach this is clearly, historically, we have a few good examples of European companies that took it step by step, selected a local Euronext listing in Amsterdam, if you want, a smaller one. And then, kind of work the local capital environment when they're typically in their earlier stages of development. And others managed very well going straight to NASDAQ and kind of skipping that intermediate stop. There are also bad examples of definitely companies that in a window, as we've seen over the last, let's say, decade almost, a good capital market environment up until, of course, 2022, the beginning. Companies that did it too momentum driven. And those companies clearly find themselves between a rock and a hard place. Nice listing, good IPO, in need for a follow-on, and they end up sometimes, if they're too early, their news flow is not strong enough, kind of end up in a very cold capital market environment and see their market cap, completely dwarfing there. Those companies are in a very tough place, I think. And will they learn from it? I think, yes, the sector will learn from it. Never waste a good crisis, people always say. So lessons learned from that. We at Gilde are very cautious in listing our companies, very cautious. Arguably, there might have been instances where we are also too aggressive, but overall, we're very cautious. Is the team ready? Are they ready to kind of talk to Wall Street investors, not only during the roadshow, but really build long-term relationships? And that skill set, that investor relations skill set, is often lacking. People are in Europe, teams are often unaware of it. We see it our fiduciary duty to educate them, leverage our experience, how it can go wrong, and what it means once you're out there in NASDAQ, typically in stormy weathers like this. So that's
one of the things that sort of came through, obviously, is that, you have the roadshow, but after you go public, you need still to be talking to investors. You need to be in New York. You need to be doing that. And I suppose one of the issues for Europe is that, then companies, so they may then end up having their CEO or their CFO for sure, maybe the CEO as well, in New York. And then at some point, do they start to say, well, we've got these people in New York, maybe we'll move more of our management team in New York. Maybe we stop being a European company and just move to the US. Is that a dynamic you think can ever be overcome in Europe?
I'm not so sure whether I would be a supporter of that dynamic. I think Europe clearly should continue to leverage its strength, and it's always the case that the core of the science and the people in the labs and the real innovation has, usually is deeply rooted into Europe, wherever the hub is, where their company is. Definitely, you can think of upgrading the management team with local US East Coast positions, as you refer to. And then typically you think of CFOs, sometimes even CEOs or IR people, continuously maintaining a relationship with those investors. It's very important. But clearly, I think a complete relocation is very often not a good idea. We also have an office in Boston. We see our field of, in which we operate as a kind of transatlantic field. I would say global, but Gilde is not yet in Asia. But clearly transatlantic, and we see it as our duty to help our companies do that. But it doesn't mean completely relocating the complete company to the US. I don't think that's a smart thing to do.
And so, this, I'm going to tap in and extend something that you brought up earlier with mergers. And, one of the hot button topics was really mergers in particular. Some people arguing that reverse mergers are not a great path to success, that they're basically a distraction for a management team that should be focusing on their pipeline. And, other people were arguing this can be a viable route to survival before you can thrive. So how do you think about reverse mergers? And then, you also raised earlier the issue of biotech to biotech deals. And, what are you seeing on that front?
Yeah, I think creativity, especially in a challenging environment like this, when need be to be creative, is always one of the leadership skills that a CEO has. Creating optionalities for its investors, especially in distress situation. I mean, at board levels, we always drive the discussion not only towards how to optimize plan A, but how does plan B and C and D look like? A reverse merger, I would say, probably ends up more in plan C than B. But nevertheless, it's
not plan E, right?
No, it's not plan E. No.
Yeah.
Yeah.
So, let's turn to another way of thinking about strategy. And one of the features that came out of our data is a real strong swing, in particular among private companies, but also among the more successful public ones, for funding platform companies over asset-centric ones. And obviously, this is a cycle that the industry goes through from time to time. So, at the same time, we've come out of an era of a large amount of, exciting biology that people have created platform companies around. But at the same time, in particular, when the markets tighten, valuations are based on lead assets, right? And everybody wants an asset, right? That's what you commercialize. So how are you advising your companies to walk this very tight rope between spending resources on the lead asset, which is also risky, and investing in the platform, which can yield alternatives that spread the risk more? How do you navigate that?
Yeah, clearly we at Gilde, we still like product pipelines, Simone. We try to stay away from binary risk, at least at company and investment case level. At a single product level, there's always binary risk, right? So we try to kind of embed the inherent risk profile of drug discovery and development in an environment of risk mitigation and risk diversification. Now that has a cost, to your point. It's very capital intensive to maintain a platform. Now, when we come across platforms, specifically thinking about therapeutic modalities, we're now living in times where the number of modalities is not infinite. It's finite, kind of. We now have cell therapy, gene therapy. There probably will be some others in 5 years' time. But for us at Gilde, it really means that these technology platforms need to operate as product engines in a cost-efficient way. We have good experience historically with European companies build on those foundations. I think you have quite a few. The first deal I worked on when I joined Gilde in 2001 was Applings, llama antibodies. I never heard about llama antibodies, but also less disruptive technologies. For example, Ascendis that was using transient pegylation. Pegylation was well known to the industry. Transient pegylation was just a small tweak to it. It wasn't in and of itself the reason to invest. A combination of that with a drug hunter. And now I come to your point, a drug hunter that knows exactly when and how to apply this to which product market combination. That was for us the reason to engage early on as a lead investor in the Series A. And right now, Ascendis, nobody talks about its transient pegylation technology anymore. They call it Transcon, and they apply it to really interesting products. So yes, you're right. At the end of the day, it's all about products. It's not only about products. At Gilde, we've elevated our thinking over the years to products that not only provide better care, but also at affordable or lower cost. So early on, we start to bring in those metrics and measurements. What I'm telling to my CEOs in terms of maintaining their platforms in times of capital limitations is, think about partnering. If you can't maintain your platform the way you want to do it, think about partnering. Applings was very good at it, almost too good that it almost became a service company, but nevertheless, it managed to advance its lead product. But don't underinvest in it. And by the way, it's not only platform companies we invest in. We also invest just in product pipelines.
Well, that is a great place to end. Thank you very much. I know I'll see you next year at BioEquity in San Sebastian, but I hope I'll see you before then as well. Thank you very much, Arthur.
Thank you very much. Looking forward to it. Bye-bye.
The BioCentury Show is brought to you by the second BioCentury Bay Helix East-West Biopharma Summit. Join us October 2nd to 4th in Kendall Square to debate how to globalize biopharma innovation to benefit patients and achieve an ROI for investors.